Inside America's Boardrooms, the informational show for board members and corporate secretaries. Brought to you with Knowledge Partners, the Center for Audit Quality, and PwC. Along with content contributors Equilar, Meridian Compensation Partners, Wilson Sonsini Goodrich and Rosati, Donnelley Financial Solutions, and the Society for Corporate Governance.
Welcome to this edition of Inside America's Boardrooms. I'm TK Kerstetter, the CEO of Boardroom Resources and the co-founder and editor-at-large of Corporate Board Member Magazine. It's my pleasure to welcome you to the show, and we're here at the studios of the Conference Board that is our host, and we certainly appreciate them hosting the show. So today we're going to talk about something that's very current on a lot of companies and boards' minds, and that's the new CEO Pay Ratio disclosure, which is quickly coming down the pike. And who better to talk about something like that than Ron Schneider, who's the Director of Corporate Governance Services for Donnelley Financial Solutions. Welcome back, Ron.
TK, thank you.
I know that you're hot and heavy on this topic. I know you had a webinar yesterday with a large audience, so we know that it's a very current topic. So my first question is sort of what's created this demand? What are the challenges that exist for companies in this first time CEO pay ratio disclosure?
Okay, so there's been an intense focus on executive pay, and that remains unabated. CEO pay has been, well known for years. It's in the proxy every year. What's new will be that companies have to calculate or estimate who the median employee is on pay, and then present the ratio of the CEO pay to that median employee. And for boards, it's a ratio. So there's a numerator and a denominator. And so, boards have quite a bit to do with the numerator, the CEO pay, but they may have very little to do in creating the denominator, the median employee and the overall wage levels. And so, calculating it, identifying the median employee, what to do with multinational companies. Companies have been working with their law firms and compensation consultants for years. This has been known to be coming for several years. Now, a major question for the last several years, or wish, was companies hoping that this would go away or be delayed. Well, here we are, as you said, it's imminent. For most companies, it'll be in their 2018 proxy, reflecting on 2017 pay. Some companies, it'll be going into a 10K, an S1, a merger proxy, whatever comes first. Is it going to be a really big event? We'll see. There were some voluntary early adopters for the last several years, companies like Northwest Energy, Noble Energy, and others, some of which came up with their own kind of a ratio, others which tried to track roughly the SEC version. The common denominator between all the early disclosures was ratios primarily of less than 50 to 1, all less than 100 to 1, so maybe they didn't have too much to worry about in terms of perception, and it seems to have been a non-event there. However, there will be companies in every industry group and market cap that are the high or the low, the outliers, and most likely they will get quite a bit of attention.
So the things that cause all that is the work and the stuff up to it, but the thing that everybody's waiting to see and that causes consternation is how is the media going to react to it? How is the activist going to react to it? How is the low-paid employees going to react to it? Isn't that what's really creating the angst in this?
Yes, and I think that over the last couple of years, companies have been paying a lot of attention to what's the internal reaction going to be. For the first time, many employers are going to discover that they're paid below the median. They may have thought so, they may not have known, and the likes. And so most companies, to our knowledge, are preparing internal messaging, either to be proactive about it once the ratio comes out or even before, or to have as talking points so they can explain what the rule is, how it's calculated, the impact of equity awards, which fuel the CEO's pay, versus total rewards, benefits and and the likes that that they want employees to focus on.
Yeah. One of the interesting things that you told me before we sat down was at your webinar the other day that there was an interesting reaction to how many people were prepared for this. Share with our audience a little bit about what you learned, from the webinar.
Well, we like engagement, so we entertain questions from the audience during the webinar, but we also ask them our own questions. So we had over 300 actually on live, and we had several polling questions. And the first one was, how prepared are you in terms of methodology and identifying the median employee for this disclosure? And the choices were fully ready, which was 30%, getting there, still some work to do, 50%, and significant work remaining, almost 25%. Now, I believe most of these are probably March filers, so they have a few more weeks, and I think that they're going to get there. They're going to get to the finish line. But it's interesting that many said, we're not there yet.
Yeah, well, I'm sure that's what created the interest. And for that reason, you mentioned that some have pre-announced in previous years. What do you hear other companies sort of doing? I understand you did say that they're going to have internal meetings, but do you hear anything else that's unique that companies are doing to sort of prepare for the unexpected?
Absolutely. I mean, I remember, and I'm sure you do, going back 20 plus years ago, the regular newspaper articles about the holy cow pay figures when a CEO's pay was disclosed in a proxy, and back then 3 million might have been holy cow.
Yeah.
And often these stories weren't very analytical, more shock value. Activists in the past have been known opportunistically to seize on governance issues and compensation issues to try to gain some support amongst mainstream investors, even if that's not really their pet issue. So it's reasonable to expect that high ratios could be another point that activists will take advantage of. Story ideas for media, again, CEO pay has been out there for years. Now you have this whole ratio in the employee population. So companies and their boards have to be prepared for the internal employee reaction. I think most are getting there. For media, we live in an activist environment. For this to be one of the activist talking points as well. And I think also, just to remind people in general of the company's media policy and social media policy, because this is going to, this strikes home to everybody.
Yeah. So we have about 2 minutes left. So, I mean, this is sort of your bag in dealing with disclosures and creativity. So what would you recommend those people that are sitting out there today? What boxes should they have checked as they prepare to let this disclosure go?
Sure. Well, I mean, if they don't know it yet, companies will soon know where their ratios relative to their peers, and because not all will be developed in an exact similar comparable fashion, there will be some variability. What we've been told so far is for proxy advisors, it's not. It's a data point in their reports, but this year it's not a driver of vote recommendations. Same with investors generally. We know that labor is intensely interested in this. They're the ones that were pushing for it the hardest. So I think companies want to know, and boards want to know, their general methodology, where their ratio is relative to peers, not just to companies in general, but to their peers. And if they are likely to appear to be outliers, be prepared with understand the drivers of that and be prepared. And one person's high ratio, could say, well, the CEO is paid too much. But if it's because of a strong stock market and tax reform, and the CEO is benefiting, certainly more than I don't know how many media employees benefit from equity awards, that's only going to exacerbate it. So if I'm a shareholder, if that's a driver of a higher ratio, am I upset? Versus, it is a broader wage divide among employees. So multiple audiences, a lot we don't know yet. The filings are already coming in, by the way. I mean, they're accelerating, each day, starting this week, and they've been coming in IPO S1s, merger proxy statements, 10Ks, very soon to be coming in proxies, 4 weeks from now, we'll have an awful lot of proxies. Plenty of people are digging into that information. Comp consultants, attorneys, Equilar, and other firms like proxy advisors. So there will be a lot of data. So I think be prepared for the internal reaction. Be prepared for what does your number consist of? What drives it? Are you an outlier compared to peers? And be prepared. And that's just in year one. I think for a lot of companies, this is going to be the end of a long road, and they'll have gotten there, it'll be out there, and that'll be the end of it. And then, it'll just be, they don't have to calculate the median employee for another 3 years unless there's a major change. For outlier companies, we'll see. It's going to be a big, interesting TBD. And then what happens in year two when proxy advisors develop policies around this, and so do investors, and it becomes less of an extraneous data point, but do companies build it more into their whole pay for performance alignment story?
Well, I suspect this won't be the last time you're answering questions around the CEO pay ratio. And Ron, I want to thank you for taking the time and updating us at least to where it stands currently. And we'll watch what happens in the months ahead. So with that, I want to thank everybody for tuning into this particular episode. We'll be back again next week when we take another look at issues that'll help you be a better board member or committee member. So we'll see you then.
Join us again next week for Inside America's Boardrooms. Brought to you with Knowledge Partners, the Center for Audit Quality, and PwC. Along with content contributors Equilar, Meridian Compensation Partners, Wilson Sonsini Goodrich and Rosati, Donnelley Financial Solutions, and the Society for Corporate Governance.